Throughput accounting then is the last area in the first part of our syllabus, our specialist cost and management accounting techniques. Throughput accounting is essentially a performance management system that helps us understand where we should be focusing our production capacity. It's based on the theory of constraints. So I've got a little bit in this chapter in terms of the theory and what it's all about, and then also we do have some calculations, so we've got some ratios in here to learn, and then we can also look at how we can use throughput accounting with decision making. Now this is likely to feature for all of a question. Now, obviously it could just have smaller elements being examined. This then feeds into the next area of our syllabus as well, where we look at limiting factors, as well as looking at it on a traditional basis, which we see in chapter 3, and you will have seen at F2. We can also look at that in a throughput accounting environment as well. So throughput accounting and theory of constraints then, basically what we want to do here is turn our materials into sales as quickly as possible, and that way we can maximise our throughput, maximise our cash generated from sales. Now what the theory of constraints does is therefore focus on any bottlenecks in the production process, because we want to get rid of those as they prevent this throughput idea. So we've got a little diagram here which is various stages that our production might go through. So we buy our raw materials, it goes to the first stage in the process, which is materials preparation, and what we're saying here is that we can process 100 units an hour. Those then get passed to component preparation, but only 50 units an hour can be processed here. That then feeds on to final assembly, which can process at 100 units an hour again. Now component preparation, because it's only able to do with 50 an hour, this is therefore our bottleneck. This is slowing down our production. Now you can see that is our bottleneck. You might see it referred to as a binding constraint. Now we've got a process here in your notes to deal with your bottleneck. Basically we need to identify what it is, and we then need to exploit it. In other words, we want to get the highest possible output from our bottleneck. If that can make 50 units an hour, it's got to go at 50 units an hour. Any less and it's really slowing down our production. Now we never want that to be delayed, so because of that we will have a little bit of buffer stock immediately before the constraint. If some of the units that come through aren't the desired quality, we've got to scrap them. If there's nothing there just prior to this process, we can't then make 50 units now. If we've scrapped 2, we're only going to make 48. So we will have a little bit of buffer stock immediately prior to the bottleneck, but we don't want any other stock in our process at all. What we then do is basically make everything else operate at the same speed, so that we're not building up any work in progress. Okay, so materials prep, what we would then do is say, right, you're no longer doing 100 units an hour, you're going to do 50 units an hour as well. If we let the work in progress build up, we've paid for the materials, they're then sitting there for ages before they get processed, and we're delaying us being able to get the money back from those eventual sales. Now that's what we would do in the short term. In the longer term, what we want to do is get rid of the bottleneck. Now what we'll do here, maybe we can increase the resources, maybe we can look at improving the efficiency in there. That's not going to be an overnight fix, that's going to be a longer term solution. Now once we have fixed that, what it says here, return to step 1. Basically once you solve one area, you'll probably have another area which will be going slower than the others, so you've then got another bottleneck which you then need to fix. Now, throughput accounting has these three concepts at heart. So, all factory costs are fixed in the short run, with the exception of materials. So, materials are the only variable cost that we have in a throughput environment. Everything else is assumed to be fixed. So, even labour, even if you've got variable labour, and we assume that we are paying those guys a weekly salary. Okay, if we're going to make less units tomorrow, we've still got to pay them the same salary. We might be able to change how many hours they work next week or next month, but we can't change the immediate future. So for that reason, the only cost that we can actually influence in the immediate term is how many materials we buy. Now, we also assume that we're in a just-in-time environment, because we've talked about the fact that we don't want stock. We're going to have zero stock other than immediately prior to our bottleneck. Now that means we're going to be happy to accept some idle time, because remember, we've got to pay for that labour anyway. It's not changing the cost. Now what that means is our stock is valued at material cost only, so we're not adding any value into profit until we make a sale. By making a unit and not selling it, it's costing us as a business. So we're recognising that and only adding value when that sale is made. So our view of profit, what we call return, is actually determined by the rate at which we generate throughput. So as I said, how quickly we can turn those raw materials into sales and therefore get some cash in return. So you've got a little table here comparing traditional and throughput accounting. Worth having a read of that, making sure you understand those elements are the sort of things that you could bring into a discussion requirement in the exam. Now section 2 introduces the ratios that we need in a throughput accounting environment. We've got three key ratios really. One is return per hour, the other cost per hour, and then our throughput accounting ratio itself. The first one we're given here, total factory costs, well that feeds into our cost per hour formulae. So return per hour, sales return less material purchases, nothing else in there at all. Now we tend to refer to these ratios as per hour, but you'll notice in the formulae there, it's just talking about time. Okay, if you're given a question where everything is in days, or weeks, or months, that's fine, it doesn't matter. You don't have to get it to an hour, the resulting ratio will be the same. What you do have to be is make sure, for whatever it is you're calculating, everything has the same measure of time. Are basically everything except materials. And the only short-term cost, everything else is deemed to be fixed. So bring everything else into there, and then your throughput accounting ratio is the combination of those other two ratios. So if we have a look at lecture example 1, we've got to calculate our throughput accounting ratio for the key resource for an average hour. So what we have here is actually quite a detailed scenario for a question which is just asking us to calculate our throughput accounting ratio. Let's have a look at that scenario. Got a company called MN, and they make automated industrial trolleys known as TRLs, let's call them trolleys. Each trolley sells for 2,000, so that needs to come into our return. The material cost is 600, so again that would come into our return. So our return per unit we can see is 1,400. Labour and variable overhead, 5,500 and 8,000 a week. Fixed production cost, 450 per annum. Okay, so be careful, got a difference in time periods here. Marketing and admin costs are 265. Now, marketing and admin costs we're not actually interested in, we only want the production costs. So we don't need to do anything with that there. The trolleys are made on 3 different machines. Machine X makes the 4 frame panels required for each trolley, and its maximum output is 180 frame panels. Machine X is old and unreliable, and it breaks down from time to time. So it's estimated that 20 hours of production are lost per month. So whilst it's capable of making 180 frames, we're not actually going to get 180 frames from it. Now here, again, note you've got a difference in time. The frames were per week, but this loss is per month. Machine Y can deal with 52 trolleys, and machine Z, which is old but reasonably reliable, can do 30. The company has recently introduced just in time. We don't want to hold work in progress. The company operates a 40-hour week, 48 weeks a year. So quite a bit in here to kind of get your head around and get to grips with before calculating the throughput accounting ratio. The first thing we need to work out is which machine is our key resource. One of these will be producing at lower output than the others. We can see it's not machine Y, because that makes more trolleys than Z. We need to understand how many machine X makes, compare that with Z, identify our bottleneck, and then we can calculate our throughput accounting ratio for that machine. So let's have a go at example 1. So firstly, we need to identify our bottleneck machine. So we need to do some work around machine X. We're told that it loses 20 hours a month. All the other data we're given though is in weeks. So let's get that down to weeks. We lose 5 hours a week. Now that is a loss of 12.5%. Remember, our total hours a week were 40, so 5 over 40 gives you the 12.5%. So how much can machine X therefore make? Well, 180 less that 12.5% is able to make 157.5 trolleys. Now, 157.5 panels. Now we need 4 panels to make each trolley, so what we're able to make 39 trolleys. Machine Y, we were told, could make 52, and machine Z could make 30. So actually, even though machine X was the unreliable machine, it's not our bottleneck. Machine Z has the lowest output, and so that is our bottleneck. So having identified our bottleneck, we can now think about calculating our throughput accounting ratio. Now remember, that is made up of your return per hour and your cost per hour. So let's remind ourselves of the return per hour ratio first of all. We've got our sales less materials purchased divided by our time. Now we know that our return per unit, sales less materials purchased, was 1400. We identified that from reading through the requirements, and we've now identified that machine Z is the bottleneck and machine Z is capable of making 30 trolleys. So our return, 30 times 1400 in units. We then got to divide that by the amount of time involved. Well, in a week we have 40 hours. So we get to a return per hour of 1050. So if we then have a look at our cost per hour, remember that's our total factory cost over the time on our key resource. Now in terms of the cost that we've got here, we've got our labour and overhead, which are 5,500, and $8,000 per week. And then the other costs that we've got here are our fixed production costs. Now we're told those are $450,000 per annum. We know that we have 48 weeks in a year, so we want to bring in a 48th of that cost. We're then going to divide that by the time on our key resource. We've got 40 hours in our week, so we divide that by 40, and that will give us a cost per hour of 572. So if we bring those two elements together into our throughput accounting ratio, we're going to bring in our return per hour of 1,050, divide that by our cost per hour of 572, and we get our throughput accounting ratio, which is 1.84.
You could also be asked to think about how you could make improvements to the throughput accounting ratio. So you need to think about practical ways then which are going to improve the throughput ratio. The starting point then for this is to consider the formula. So we're looking at the return per hour divided by the cost per hour. And in order to improve the ratio, we need to either increase the return per hour or decrease the cost per hour. So the return per hour then is the sales revenue minus the purchases of materials. So here then we're looking at increasing the selling price. Well, if you increase the selling price, that will increase the return per hour, which in turn will increase the throughput ratio. In the same way that buying cheaper materials will also improve the return per hour and therefore the throughput ratio. So the correct answer here is going to be C, because both of these options would increase the throughput ratio. Other actions that would also improve the ratio would be to decrease labour costs or other factory costs, and also to decrease the amount of time that the product spent on the bottleneck resource.
So throughput accounting and decision making then, basically we will rank our products or our divisions by the throughput accounting ratio. The higher the ratio, the better for the business. Now just note here, if you've got two or more products that are made within the same factory, you don't have to go as far as calculating the throughput accounting ratio. The factory costs will be the same for the factory. We don't try and carve them up amongst the products, so they're going to be identical. So the only thing that's going to change is your return. So products in the same factory, just go to return, unless obviously the question specifically asks you to calculate the throughput accounting ratio. If it just wants to know which are the best performing, then use return. Okay. Now your ratio should obviously be greater than 1 if your product is viable. Now one of the other ways that we can use the throughput accounting ratio is in our performance management. With traditional profit measures, we know that the more items we have in inventory, the more gets reduced from our cost of sales within that closing inventory line. So we actually end up looking more profitable. Now what we want to do here is obviously not build for inventory, and particularly in modern day thinking in terms of just-in-time environment, certainly that goes against that philosophy. So throughput accounting can be used instead to understand who is performing well within the business. Now lecture example 3 is an example which just demonstrates this use of a throughput accounting ratio. So what we've got to do is firstly calculate which manager would benefit if bonuses were given on profit, and then the throughput accounting ratio. So this is going to demonstrate that difference in performance measurement. So here we've got two separate divisions, and they make and sell products with identical cost structures. So we've got our selling price, our materials, our labour. We've then got fixed production overheads of $200,000 per month, and that's absorbed across the normal production level of 10,000 units. So you need to calculate your overhead absorption rate here. 200,000 over 10,000 units, you're going to be looking at a rate of $20 per unit. Each division, we've got a capacity of 20,000 hours. Will makes and sells 10,000 units. Grace makes 12,000 but sells only 9.5. We've got no opening inventory at all. Now it'd be worth you guys having a go at profit calculation yourselves. That is some revision of what we looked at in chapter 1. So we've obviously got to do it on an absorption costing basis here. So have a go at preparing the answer for part A. So if you pause your presentation in order to do that. Okay, so hopefully your answer to part A would look something like this. So for Will and Grace, we've got their sales units multiplied by $50 a unit. For materials, we're bringing in the production units. So for Will, 10,000. Grace 12,000, and multiplying that by the direct material cost of $12 a unit. The labour, well, this is at $8 a unit, and again that applies to the 10,000 units for Will, the 12,000 for Grace. Fixed production cost is where we need the OAR, and we calculated that to be 20 a unit, and again multiplied by 10 or 12,000 to get our fixed production costs. Now if we just concentrate on Will for a moment, in terms of the closing stock, he had nothing at the start of the period. He made and sold exactly the same amount, so he's got no closing inventory left at all. If we look at the adjustment for any over or under absorption, well, you do this by comparing your actual overhead with your absorbed. Now what we have in our income statement is obviously the absorbed overhead. The question doesn't make it clear what is the actual overhead, so we're going to make an assumption that the actual overhead is the same as the kind of normal level that we're given, the 200,000. So because his absorbed is the same as that actual 200, he has no over or under absorption. If we look at Grace, you can see here she's absorbed 240. Comparing that with the 200, she's overcharged by 40,000. So we need to reduce the cost in her income statement by 40 to reflect that. The only other item here for Grace is the closing inventory. So if we just have a quick look at that, we know that she made 12,000 units. Okay, so that was her production. Of that, she then sold 9,500 units, which left her with 2,500 units of closing inventory. That then needs to be valued at the full cost to get the value of her inventory. Now, the full cost is made up of the variable, which was the materials and labour, so 12 and 8 was 20, and then we also have the fixed cost, which is our overhead absorption rate of 20, so we're valuing each of those units at 40, and that is how we get the $100,000. Okay. So the gross profit for these two then, 100,000 for Will and 135,000 for Grace. Okay, so this is their gross profit. Now on that basis, Grace looks as though she is the better performing manager, so Grace will get the bonus. Now if you have a look at it, you can argue that that doesn't seem very fair. She's made less sales than Will, and yet she's got more profit. How has she managed to do that? Well, she's basically managed to do it by her closing inventory here. by making more items and not selling them, she has reduced her costs by 100,000. If that adjustment wasn't there, she'd only be making 35,000 of profit. Now you could argue those units are there in the stock ready to be sold day one of the next period, but remember all those items that are in stock, that's our money tied up in that stock. We're not going to get any return on it until we make a sale. So let's now have a look at the manager that performs the best under Throughput Accounting. So let's bring in a column for both of them. Okay, now Throughput Accounting ratio, remember, is made up of return and cost per hour. So if we deal with return, first of all, we know that that is the sales less our material costs. Now, having already calculated our profit, we've already got some of these numbers. So the sales for both of them, Will had 500,000, Grace had 475. In terms of the materials, Will spent $12 on 10,000 units. Grace spent $12 on 12,000 units. Okay, so the return that they have, in total, Will has 380, Grace 331. Now what we want here is return per hour, so we're going to divide that by the hours, and the hours we want to bring in here are our capacity hours. That's how many hours we could be producing for, so that's 20,000 in both instances. So return per hour for Will is $19. For Grace, it is $16.56. Okay, so that's the top half of our Throughput Accounting formulae. If we now have a look at the cost, well, the costs that we need to bring in here are basically everything except the materials. So we've got our labour and we've got our production overhead. So in terms of the labour, the rate was $8 a unit. So for Will that was 80,000. For Grace that was 96,000. In terms of the production overhead, well, we know the actual costs there were 200,000. Don't bring in the absorbed because we're not doing absorption cost in profit any longer. So we've got 280 in terms of costs for Will. We've got 296 as our costs for Grace. So again, we want to get that per hour. So if I bring in my capacity hours of 20,000, and then calculate our cost per hour. So for Will it's 14, for Grace it's 1480. Okay, so that's both of the elements that we need for our Throughput Accounting ratio. So if I bring that in, for Will we've got 19 over 14, for Grace we've got 1656 over 1480. So what we get here is 1.36 for Will and 1.12 for Grace. Now what we can see here is the highest is the 1.36. So in this case, Will would get the bonus. Now you can see here that Will is being rewarded on the basis of his sales. That sort of benefit that Grace had under profit because of the closing inventory is stripped out, not adding any value until we make a sale. We're bringing in the return and then we're taking out all of those costs. Okay, so if we have a look at some of the key things then from our Throughput Accounting chapter. Basically, throughput accounting is a technique which focuses on maximising throughput. What we're concerned with doing is turning our sales into cash as quickly as possible. So we're just measuring our sales less materials to get that throughput return there. Labour, variable overheads, any cost other than materials are seen as fixed in the short term. And then got our key ratios there. And then remember that decisions are made with reference to the throughput accounting ratio. It should be greater than 1, and the higher the ratio, the better.